Good morning, everyone. A very warm welcome to the GST and Customs recent critical developments and way forward for industry October 2022, organized by Tax Guru. I would like to introduce our speaker, Mr. Vivek Jalan. Mr. Vivek Jalan is qualified chartered accountant, qualified LLM and LLB. He is the chairperson of the Indirect Tax Core Group of the CII. Also, he is the chairperson of Fiscal Affairs Committee of BCCI. He is a regular speaker of various professional forums on the key areas of direct and indirect taxes. During the session, please put your video and microphone off. If anyone has any query, please write in the chat box. We will answer all your queries at the end of the session. Now we would like to request our speaker Vivek sir to take the session forward.
Thanks, Tikli. Am I audible?
Yes, sir, you are audible.
Thanks. So, good morning to all the participants present here, and thank you to Tax Guru for holding this session along with us in a short span of time. Thanks to all the participants to joining this early morning Saturday session on the recent developments in GST and customs. In fact, friends, we had thought that on 13th of October, the apex court would decide on the eligibility or otherwise of input tax credit on construction and works contract services under 17(5)(d) in the case of Safari Retreats Private Limited versus Union of India. And therefore, we thought that it is best that we hold this session immediately after the decision and we discuss that threadbare. However, instead of Safari Retreats case, the Honorable Apex Court has decided in another taxation case in income tax in the case of Checkmate Enterprises and others, including Burgeon Paints, etc., wherein it has held that the Provident Fund and ESI contributed by the employees to the employers, if not deposited by the employers within the due date, would be added to the income and the deduction would be lost forever in terms of the section 36(1)(5)(a) and 43(b) of the Income Tax Act. So, the Honorable Apex Court has decided in an income tax case against the taxpayers. Possibly, it did not want to uh, decide in another tax case in GST in the case of Safari Retreats on the same very day. Two big tax judgments they did not want to come, and therefore now the matter in the case of Safari Retreats versus Union of India, that is listed on 23rd of November 2022. Nonetheless, there are other cases wherein similar matters have been argued and notices have been issued by the Honorable Apex Court to the respondents to respond. Additional writ petitions in the same matter has been filed and tagged with Safari Retreats case. We will discuss that, those matters and the issues therein, because this is a large issue and whatever might be the judgment, it would be a landmark judgment in GST, just like you have seen in the case of Mohit Minerals in the matter of ocean freights. And this case would be a little different. We will discuss that. We will also discuss the all the items in the agenda. Just before starting, kindly excuse me in between for a few seconds because I have a small throat problem, and so I may need to take a break for a few seconds in between for a few times. So kindly excuse me on that. So first to start with, all the amendments which have been effected under GST from 1st of October 2022, some of which you might be knowing, which have been effected by enacting and notifying the Finance Act 2022 from 1st of October. However, there are certain amendments by notification 19 and 20 to the rules, which have gone not that much noticed, but they are very, very important amendments and would have a tremendous bearing and impact on all the taxpayers across the country. One of the most important one of them is the amendment to Rule 37 of the CGST rules, read and which gets power from the second proviso to section 16 subsection 2 of the CGST Act. What is the second proviso to 16 subsection 2 of the CGST Act? It provides that any recipient of input tax on goods or services received from any supplier on which it has taken input tax credit, but the recipient fails to pay to the supplier within 180 days of the date of the invoice, that input tax credit which the recipient has taken on those invoices of the suppliers would be added to the output tax liability along with interest thereon. This is as per 16 subsection 2 second proviso, right? Rule 37 lays down the machinery to the second proviso of 16 subsection 2, which used to say that in case the recipient has taken the input tax credit on goods or services received from a supplier, but has not devolved the taxable value as well as the tax thereon, then subject to the proportion of the taxable value and tax thereon, and limited to the proportion of the taxable value and tax thereon on such invoices which has not been paid within 180 days, to that extent and that proportion, the amount of input tax credit which was earlier taken by the recipient would have had to be added to the recipient's output tax liability, and interest thereon under section 50 subsection 1. It's very specifically stated. Interest thereon under section 50 subsection 1 would have to be devolved. Now, what they have amended this rule 37.2 is they have removed this word proportionate, right? You can see it on your screen. So they have just said that in case a recipient takes the input tax credit on goods or services supplied by a supplier, and if it does not pay the supplier within 180 days, then the input tax credit so taken would have to be reversed along with interest under section 50, right? So two major changes. First, three major changes in fact. First, and the most important change, is they have removed this word proportionate. That is, what is understood by this amendment is they want to say that if a supplier's bill is of say 100 plus 18 rupees GST, total 118, and if you as a recipient of those goods or services pays even 90 rupees plus 15 rupees GST, say for example, then also the entire input tax credit of 15 rupees which you have taken, right, on, or if you have taken 18 rupees input tax credit on that, then the entire 18 rupees, including 15 rupees of input tax credit for which you have already paid the GST to the supplier, even that 15 rupees would require to be reversed by you as a recipient of input tax credit. So there is no benefit of proportionate payment. Friends, please keep on typing your questions in the chat box, right? And we would take all the questions in the last 15 minutes of the webinar. So let us, keep on accumulating those questions. Uh, so this rule 37 is, as of now, what it seems from this amendment would create a major hardship for the taxpayers, and you as taxpayers or as tax consultants of your companies or as professionals have to make major changes in your payable section. What are the changes which you need to make apropos this amendment to rule 37? Now in most of the companies, what happens is that, say a supplier gives you a bill of 100 plus 18. You contest, you say no, 100 rupees I will not pay, I will pay you only 90 rupees. So what the payables department does, it scratches through that 100 rupees and it makes 90 rupees, it edits that invoice for 90 rupees plus proportionate GST, say 15 rupees, and it makes the payment of 105 rupees after TDS, and it accounts for that invoice of 118 rupees as 105 rupees, right? What the supplier does many a times, the supplier does not amend its GSTR1 also. Many a times this amendment to the invoice is also under dispute by the supplier. Friends, in these cases, it will be very difficult going forward to convince the department of the eligibility of this 15 rupees of input tax credit also, for which the payment has been devolved, right? So, two steps need to be taken by the payables department of every organization. Number one, if you are making a short payment of any invoice of the supplier, ensure that you get a credit note for the short payment, right? So in the my example, for an invoice of 100 plus 18 GST, you have paid 90 plus 15 rupees GST, right? So you get a credit note of 10 rupees plus 3 rupees GST. Then the matter is closed, right? And you report accordingly in GSTR 3B, or at least take a consent letter from your supplier that this is the payment against your tax invoice and your supplier has accepted that payment of 90 plus 15 rupees as full and final payment of his invoice. This is very important. If you have this, even this declaration from your supplier that he has accepted this 90 plus 15 rupees as full and final settlement of his invoice of 100 plus 18 rupees, then what you can do is you can take the shelter of the words fails to pay. Section 16(2) second provision along with section rule 37, it says that this disallowance or this reversal of ITC would only be applicable in case you as a recipient have failed to pay the taxable amount as well as the tax. If your supplier himself declares that he has accepted the amount as full and final settlement, then you can at least take shelter and disclose that there is no failure of payment and hence there is no applicability of second provision to section 16(2) read with rule 37 as amended, right? So this is a very, very important amendment. The second big issue in this amendment is that the second provision to section 16(2), it says that if you do not make the payment of the invoices of your suppliers, then the amount needs to be added to the amount of ITC which you have taken needs to be added to your output tax liability. But Rule 37 talks about reversal of input tax credit. Now the question is, what do you disclose in GSTR 3B? Well, as per our suggestion, while this matter will come up for dispute and I'm sure it will be contested in the High Court, I will tell you why it will be contested. Yet, as of now, you have to take action while filing the returns. Our suggestion is you show it as a reversal of input tax credit as per that circular 170 which has come, which requires the disclosure of reversal of input tax credit in this transaction as 4B2 in table 4B2 of your GSTR 3B return. Clear? And thereafter, when you are re-availing on payment, then you reclaim it as 4A5 all other ITC. However, the biggest issue of this is another. Now, the department has very, very cleverly, the CBIC has left the door open for payment of interest. It says you have to reverse this ITC under Rule 37 along with interest under Section 50. Now, under which subsection of Section 50 that they have removed, whether it will be under Section 50 subsection 1 or whether it will be under 50 subsection 3. If it will be under 50 subsection 1, then you are saying, gentlemen, I am going with second provision to 16(2). That is the act itself, which then I make this as a reversal, as a payment of output tax liability, because 50 subsection 1 talks about output tax liability. However, if I go by this rule, section 37, rule 37, then I show it as a reversal of input tax credit and then I go by section 50 subsection 3. Well, I am not getting into the nitty-gritties of the subsection, but it has a financial impact. If you go by 50 subsection 1, then the rate of interest is 18%. If you go by 50 subsection 3, then the rate of interest is 24%. So as per my suggestion, just few minutes back, if you show this as a reversal of input tax credit, then practically the interest of 24% would be applicable on you. However, friends, another twist to this story is 50 subsection 3. It talks about wrongful availment as well as utilization. Wrongful availment and utilization. So you can again contest that when you had availed the input tax credit, you did not know that you will not pay the supplier within 180 days. So there was no wrongful availment at all, and therefore no interest is payable in this case at all. Therefore, friends, this rule 37, as I said in the beginning of my address, is a major amendment, and the nitty-gritties need to be clarified by the CBIC going forward. Till such time, reversals of input tax credit have to be made. But the question is, what about this proportionate word? You have to take as a taxpayer a defense, and you have to take action by taking a declaration from your suppliers that they accept this part payment as a full and final settlement. And regarding interest, it is my view that interest may not be applicable once section 50 subsection 3 amendment is notified. Mind that very, very cleverly, the CBIC has notified most of the other amendments in GST, but it has not notified amendment to section 50 subsection 3, possibly due to this issue itself. So a lot of some water needs to be flown under the bridge, right? In terms of this amendment to rule 37, we have discussed this threadbare today. You might, this PPT will be shared with you. You might look into this aspect and take actions accordingly from today. Mind that while we are discussing this on the 15th of October, this rule has already been implemented from the 1st of October 2022. And therefore, action needs to be taken from 1st of October 2022 apropos the amendment of this rule 37. Friends, another amendment is rule 36, right? Rule 36 2 and rule 36 4. Well, these amendments are primarily the amendments to streamline the process of GSTR 2B. And as you know, that all the matching concept related rules and sections have been done away with in these amendments from 1st of October 2022. So this is just to streamline the GSTR 2B related amendments and to do away with all the matching provisions related amendments. But many a times taxpayers ask us, even in fact, yesterday, one of our very, very large clients, they put up a question before us that, sir, please tell me, in case my invoice is issued with, with a computer, right? Nowadays, you all issue invoices through a computer generated system via your ERPs, SAP, Oracle, etc., or even Tally. So the question was that whether the signature is mandatory in that invoice or not, and whether a digital signature by the company is will be accepted or not. Friends, this question was asked by us in the very beginning of the COVID period when all the finance departments were working from home. Even now it is asked by from us that what is the modus operandi of signature and whether signature at all is required after this GSTR 2A and 2B. Please look at rule 36 sub rule 2, which we have always stated that all the applicable particulars on your screen, you can see rule 36 sub rule 2. It states that input tax credit would be denied to a recipient in case all the applicable particulars in a tax invoice are not present in the tax invoice. As per rule 46, signature in a tax invoice is mandatory. And in case a signature is not there, even if a digital signature is not there in a tax invoice, then that tax invoice can be rejected and input tax credit can be denied to the recipient. So if at all you have to go digital, it is our legal submission to you that please ensure that at least your suppliers' invoices are digitally signed with a DSC, right? Which is acceptable by the Information Technology Act. Also, many a times the recipients, they do not check the input tax credit invoices, that all the particulars as per Rule 46 of the CGST rules, they are available in the supplier's invoice or not. It is again our legal submission that you have to check all your invoices, especially the larger invoices, that all the applicable details as per Rule 46 are available. Another issue after this e-invoicing is that now e-invoicing would be applicable from 1st of January, possibly to those taxpayers whose turnover is more than even 5 crore rupees. So by and large, you will be getting e-invoices from almost all your suppliers. So if your supplier who is eligible, liable to issue e-invoices, if he does not issue you a e-invoice but issues you a invoice other than an e-invoice, even then input tax credit would be denied to you. So very, very important provisions which you as a taxpayer and the GST department and professionals and finance professionals should be aware of, because all of these issues would come up under litigation. In fact, in the state of Andhra Pradesh, we have already contested in the erstwhile regime, in the central excise regime, in transitional credit forms where our invoices were not digitally signed. We had to actually get it digitally signed, and only then they were accepted as a proper transitional credit. So, you see, you must put in place a system of checking the invoices as per Rule 46 of the GST rules. Amendment to Rule 21 of the CGST rules is that in case the taxpayer does not furnish his GSTR 3B for a continuous period of 6 months, then the GST registration can be cancelled, right? Or if you are a quarterly taxpayer, then if you do not present your GSTR 3B for 2 quarters continuously, then your GST registration would be liable to be cancelled. Now, the issue with cancellation in the state of Chhattisgarh, we have noticed, we have faced this, you see, in a little different matter. The biggest issue with cancellation of GST is that once your GST number is cancelled, then you can go for an appeal within 3 months or an extended period of 4 months. However, if you do not go for an appeal for 4 months, then your commissioner appeals will not have the power even to condone your delayed application. So, if your registration is cancelled due to this provision, and even if you have not filed an appeal within 4 months, then at the commissioner appeal stage, your matter will not be able to be condoned. So thereafter, as of now, because the tribunal is not formed, then High Court remains the only option. So many of the taxpayers, they go through a liquidity crunch, and because the recipients or their customers do not pay, and they sometimes delay the GSTR 3B because of the cash crunch. Well, for those suppliers, it is important that they file their 3B and do not delay it at least for more than 6 months, because once your GST registration is cancelled, and if the appeal is not filed within 4 months, then it will become very, very difficult to revive the cancellation, right? Now, friends, as we have discussed that all the sections and the rules related to matching of input tax credit, they have been done away with, right? Because GSTR 2 and GSTR 3 are not implemented. Now, they have amended Rule 60 and all other rules. And where it was stated that GSTR 2B is an auto drafted return or statement, they have made it into auto generated. So they have said very clearly that, gentlemen, your GSTR 2B is not drafted. It is automatically generated by the IT system. Okay. Therefore, whatever is available in 2B, that is automatically generated once the supplier files his GSTR1. Therefore, please do not dispute that some supplier has filed his GSTR1, it is not reflected in GSTR2B, etc., etc. And there is therefore no mechanism. If your supplier has genuinely filed their GSTR1, not genuinely reflected in your GSTR2B, and even if your supplier has given a declaration to that impact, to that effect, then also the department can deny the input tax credit to you if it is not available in GSTR2B, because they have stated very clearly that GSTR2B is an auto generated and not an auto drafted uh, return. Also, there were two forms, Form MIS 1 and 2. If you remember, in the erstwhile VAT regime in many states like West Bengal, Maharashtra, Delhi, etc., there was a mechanism that even if it is not auto populated, even if it is not auto matched, then also there was a post return filing procedure wherein supplier would file a statement and rectify, or he would declare that yes, I have paid the tax related to this invoice, and thereafter the recipient would get the input tax credit. Same was there in Form MIS 1 and MIS 2, but now even that has been scrapped. So primarily they have made it very clear that, gentlemen, there will be no more, matching, going to the supplier, matching with him, etc. If it is not reflected in your GSTR 2B, the ITC would be denied to you. Well, the most critical amendment is the notification of section 16 subsection 2 clause BA along with section 38 amendment. Now, these are something which needs to be dwelt with again and again with the CBIC. Representations have to be made by the trade associations and the chambers of commerce to the Ministry of Finance, because these provisions will be hit by the doctrine of impossible performance. These provisions, which have been notified via section 16 to BA, read with section 38 subsection 2B of the CGST Act, they are impossible to be performed. I will dwell upon one specific provision. Till 30th September 2022, there were 5 conditions which you needed to fulfill so that you were eligible to take the input tax credit on an invoice. What were those 5 conditions? Number 1, you should have received the goods or services. Number 2, you should have got the tax invoice or any other document wide with the good or services were supplied to you. Number 3, the tax with respect to the supply so received should have been paid to the government by the supplier or whoever. Number 4, you should have filed your own GSTR 3B return as a recipient of those goods or services. Number 5, 16 to AA, that the said input tax credit should have been reflected in your GSTR 2B, right? These were the 5 conditions till 30th of September 2022. From 1st of October 2022, white section 16 to subsection BA, read with section 38, it has been notified that even if all the 5 conditions are fulfilled, and even if your GSTR 2B reflects the input tax credit, then also wide section 38 subsection 2, the input tax credit can be denied to you if it falls under the restriction specified under section 38 to clause B. Friends, the most critical provision is 38 to B3, wherein it is stated that even if your suppliers GSTR 1 and GSTR 3B does not match, even then your input tax credit as a recipient of goods or services from that supplier can be denied. I am repeating, this is very critical and it is impossible to implement as of now. There are no machinery provisions which are made available to the taxpayer to ensure that this is complied with. So even if your credit of input tax credit is reflecting in your GSTR 2B, but your supplier's GSTR 1 and 3B does not match, that is, the liability in GSTR 1 is not totally and correctly devolved in GSTR 2, 3B by your supplier, then also your input tax credit can be denied by the department. That has been notified by section 38 2B3. I will read out the provision. The input tax credit can be denied in case any goods which have been supplied and the details which have been reflected in the GSTR 1 by the registered person, the output tax payable by whom, that is the supplier, in accordance with the statement of outward supplies furnished by him, that is the supplier's GSTR 1, under the subsection during the such period as may be prescribed, exceeds the output tax paid by him during the said period by such limit as may be prescribed. So if your supplier has not paid the his corresponding output tax liability by GSTR in GSTR 1 by GSTR 3B by such limit which will be prescribed, then the input tax credit of the recipient can be denied by the department. Friends, let us wait for the rules which would be framed. But as of now, the provision has been notified and the field officers have been armed by this provision, which wires, I would say, may be required to be tested by the high courts going forward. There are other provisions in 38(2)(b). One of those are that if you are a new registrant, then for some period of time, your input tax credit can be denied. We all know that many a time, even in large companies, a new subsidiary is formed for a specific purpose in a hush hush manner, very fast manner. So in those cases, going forward, the input tax credit can be blocked for some period of time, right? Now, there are amendments to section 16 subsection 4, section 34 subsection 4, section 37 and section 39, which we are all aware of, that the time barring period for 5 things, and section 52 also. So time barring period for 4 things, I will come to the fifth. For time barring period for 4 things have been extended from the return filing date for the month of September to 30th of November. Number one, please keep on typing your questions in the chat box, right? And we will respond to those questions at the end of the webinar in the last 15 minutes. So what are the extensions in the time barring period? Number one, the input tax credit for financial year 21-22 can be now taken till 30th of November 2022. Number two, the credit notes for invoices relating to the financial year 21-22 can be filed till 30th of November 2022. The amendments to the invoices relating to financial year 21-22 can be made till 30th of November 22, and the TCS return by the e-commerce operators can be amended till 30th of November 2022. These are the 4 extensions of time barring period under GST. However, friends, for all practical purposes, 31st of October is the last date. I will tell you why. Friends, under section 39, in the month of November, you can file the returns only for transactions in the month of October. So, for input tax credit of invoices relating to FY 21-22, you have to ensure that the entry in the books of accounts are taken by 31st of October 2022. Because if the entry in the books of accounts are not taken by 31st of October 2022, if you make an entry of a purchase invoice relating to 21-22 invoice in the month of November, say 2nd of November, then tomorrow the department might litigate that, gentlemen, these are transactions which can only be reported in the month of December, and therefore this 30th November reporting which has been done by you, that is wrong, and the input tax credit can still be denied. Similarly, the credit note has to be entered in the books of account by 31st of October 2022. And thereafter, yes, the return for the month of October, that can be delayed and can be filed by 30th of November, no problem. But your purchase register or your books of accounts, that should be updated by 31st of October 2022. So this is a very, very important point in these extension of time barring period limitations? Well, many a times you see the taxpayers contend that as per circular number 2626 2017, GSTR 3B of one period can be amended by GSTR 3B of the next period or subsequent period, and there is no time frame for amendment of GSTR 3B. Well, that is not so. GSTR 3B of one financial year can be amended by GSTR 3B of the next financial year only till 30th of November of the next financial year. This is the fifth time barring period which I have discussed, right? So, friends, almost all the critical amendments in by from 1st of October 2022 we have discussed here. There are certain other amendments in the refund related where the relevant date of the SEZ supplies that has been notified. However, section 50 subsection 3 and section 49 subsection 10 have not been notified. So I am not dwelling into that as of now, because we will discuss this when they are notified. Right. Coming to our next topic. Well, there is a lot of discussion. There is a lot of debate, and there are some rumors with respect to withdrawal of the GST exemption on international outbound freight. So, in case there are two cases for outbound freight internationally, either your goods can travel by sea, by water, ocean, or it can travel by air. So, the table which is in front of you, that we have analyzed import freight as export freight. You can go to this table number 2. There can be many conditions, right? You can go through this at your own pace. However, in brief, the summary of the taxability from 1st of October 2022 is as follows. In case an Indian airline, say for example, India, you are a company A, which is exporting your goods to company B in Japan, and you are taking the services of Indian Airlines or Air India. So, and your Incode terms is CIF, right? So you tell your customer B in Japan that all inclusive you have given the rate. Therefore, now from 1st of October 2022, Indian Airlines or Air India will charge you a air freight, and on that it will charge you GST of 18%, with entire ITC being available to Air India. Till 30th of September, the GST was exempt. Air India would not have charged GST to you, but simultaneously, it would not be eligible to take the input tax credit on capital goods as well as inputs and input services also. From 1st of October, Air India can take whole input tax credit and it has to charge you 18% GST. However, in case you take the services, you as a exporter, you take the services of Japan Airlines, then due to place of supply under section 13 subsection 9 of the IGST Act, the place of supply is Japan. Supplier is in Japan, place of supply is Japan, and therefore GST is not applicable on the said transaction, right? Similarly, in case of ocean freight on outbound exports, in case you take the services of say Indian shipping line, then and the Incoterms is CIF, then the Indian shipping line may charge you GST of 5% only. In case it can take input tax credit only on ships, vessels, bunkers, and tankers. Only on those. Other than this, input services, inputs, and input tax credit on capital goods will be denied to the Indian shipping lines. However, it has got another option, this Indian shipping line. It can charge you 18% GST along with taking entire input tax credit on all inputs, input services, and capital goods. However, in case Japan shipping lines provides you as an exporter of India services, then again the services would be non-GST and no GST would be applicable on that because of section 13 subsection 9 of the IGST Act and place of supply being Japan. In case of FOB transactions, the Japan customer B would be bearing the whatever taxes and all. So it is not applicable in this case. So by and large, this is the whole scenario, right? Place of supply, we have discussed. Time of supply, we are all aware under section 14 of the CGST Act. You can go through this. You see, I will come to this. Friends, this is an analysis you will not find in the books. And this is an analysis which all the exporters have to be acquainted with. And you as a tax consultant, you as a tax professional in your organization, if you are an exporter, if your company or taxpayer is an exporter, you must make your company or client or taxpayer aware. Friends, there is a hue and cry across in all media channels. And even there are rumors, as I said, that this exemption would be re-invoked. But if you see our present analysis, in our analysis, you as an exporter should negotiate with your shipping lines or your airlines that, gentlemen, please reduce your freight rate, because your shipping line or airline would be benefiting between 1% to 3% of the cost of the goods, mind that. And if you negotiate, your cost of the goods might come down between 1% to 3%. If you see this example, let us see this. Say, for example, your cost of the goods is 1 lakh rupees. On that, freight is 20%. Generally, as per customs law, you all know that freight is taken as 20% of the cost of the goods. So now GST, if your shipping line or airline takes 100% all ITC, then the GST which would be required to be charged on this 20,000 rupees of freight is 3,600 rupees, right? 18%. However, this entire 3,600 rupees, you as an exporter, A in my example, you would be getting the entire credit of this 3,600 rupees, right? So your cost of freight still remains 20,000 rupees. However, even if you assume that the input tax credit of the shipping line or the airline, the input tax credit is even 50% of this 3,600, even then it comes to 1800. And if you see 1800 by 1 lakh rupees, if you negotiate well, your cost of the exported goods can come down by 1.8%. Even if the shipping line charges 5%, right? Even then, if you negotiate, your cost of the goods can come down by 1% or so, right? So, again, this is something, you see, I have always said that GST is not a tax. It is a business. It is a way to do business, and all GST professionals, all GST practitioners can commercially save money for your clients or your companies if GST is implemented correctly. It is a transaction tax. This is a clear example in our view in the matter. Regarding the billing, well, there are two types of bills which your shipping lines will or your freight and forwarders would make to you. If you are a freight and forwarder, you will make two kinds of bills. One is for the freight element, and one is for all other charges like agency charges, documentation charges, port charges, inspection charges, clearance charges, etc. Now, these all charges would be liable to 18% GST. Even now, even if you charge 18% GST, the freight charges would also be liable to GST now at 18% or 5%. However, the place of supply would be different. Even if you are an Indian shipping line and Indian freight and forwarder, your customer is also in India, even then your place of supply would be outside India, and therefore we suggest that you should make two bills separately for the freight element and separately for the other services as you are seeing on your screen, which you would be rendering to your client. So friends, this is what about the current withdrawal of exemption on outbound ocean freight and outbound air freight. The case of safari retreats. What is the case? It is a contest on the wires of section 17.5D. Section 17.5D on your screen, it blocks the credit of goods or services for construction of immovable property other than plant and machinery. When you have received certain goods, these goods or services on your own account, other than plant and machinery, to the extent of capitalization. Plant and machinery has been defined as any apparatus, equipment, machinery which is fixed to the earth by foundation or structural support. Other than land and building and other civil structures, and other provisions are there. So, 5 conditions. Under 17.5D, your input tax credit would be blocked if you have done a construction of what? Of immovable property other than plant and machinery on your own account to the extent capitalized. 5 conditions. First, the wires of this section has been challenged under Safari Retreats case. In the case where you have received the construction services and you are rendering outward supply of leasing of immovable property. So the petitioner in that case was in the business of renting of space in malls. And for construction of the mall, he had received certain goods or services. So the contest is again under Article 14 read with 19(1)(g) of the Constitution of India, that in case of similar construction services for residential property, you are allowing the input tax credit. But in case the same property is being leased out, you are not, you are blocking the input tax credit. So equals are being treated as unequals. Also, in case of other property other than leased property, in case the construction services or goods are used for property which has been sold out after construction, then there is no GST here. In case of leasing outward service, there is a output GST. However, you are blocking the input tax credit. This would cast a tremendous hardship and would lead to stoppage of the business of leasing, and hence is against the Article 19(1)(g) of the Constitution of India. Therefore, to this extent, 17(5)(d), to the extent where such input tax credit is used for rendering of taxable outward services, 17(5)(d) should be read down. Correct? So this was the case of Safari Retreats Private Limited, which the Honorable Odisha High Court has upheld, and now which is with the Honorable Apex Court under SLP. Another writ petition has been filed and notice has been issued to the taxpayer, to the respondent department in the case of white saffron grains, wherein another angle has been taken, the other additional points have been taken, that this building, this immovable property, can be called a plant itself, because a plant, this is acting as this immovable property. In case the immovable property is used for outward supply of services of leasing, then it can be called a plant, and therefore the input tax credit should not be denied. Nowadays, you also see many temporary structures which are made of tins, like toilets, like warehouses. You see, many of the warehouses are made of tin structures which are tied by nuts and bolts to the ground, and which can be detached and which can be dismantled without being substantially destroyed. The writ petitioner in the case of White Saffrons Limited, White Saffron Grains Limited, it has contested that these structures are not immovable properties at all. Well, if you see the Honorable Apex Court judgment in the case of Sirpur Paper Mills Limited, they have contested the same, and the Honorable Apex Court has ruled that in case any property is like Tulu pump, they have taken the example of a water pump. A water pump is attached to the ground by means of nuts and bolts to prevent it from wobbling and subsequent damage, but it cannot be said to be an immovable property because it can be dismantled without being substantially destroyed. So the writ petitioner has contested that in these kind of warehouses, they can be dismantled without being substantially destroyed and cannot be called in the immovable property, and therefore input tax credit should not be denied in those cases. So these are additional points, and thus writ petition has been tagged to this writ petition in Safari Retreats case. Friends, another important thing is the use of the word own account. Own account is generally used where you are not subsequently leasing out the property. With the same property, you are not directly providing outward services. Say you are building up a factory, and with the factory, you're not rendering one-to-one outward supply of services. But with a warehouse, with a mall, you are rendering one-to-one outward supply services. Therefore, it may be challenged that the services input services are not used on immovable property, which is used on own account. And last but not the least, if you have not capitalized these inputs or input services, then there is no question of denial of input tax credit. So all the participants here, all of you, I am sure you must be facing these kind of cases in day-to-day practice of GST. You might use these defenses. You might use the analogy drawn in these case in your businesses. Well, what comes out of this case and what is the apex court's decision, that will be known only on 23rd of November 2022. Friends, another important development is that the customs assistance in value or declaration of imported goods rules are out for public comments. Well, 14th of October was the last date to comment. Just a small understanding on what these rules are. Well, Finance Act 2022, in it enacted Section 14, subsection 1, clause 4 of the Customs Act, which said that the CBEC would form rules to identify goods or class of goods on which the valuation in case of imports of those goods can be determined in a way, in case it is found out by an inquiry that the value which is declared for import of those goods or class of goods is not truthful or accurate. So now the CBIC, after implementation or notification of these rules, it might notify certain goods or class of goods under these rules, whereby the value which is declared by the importer in the bill of entry might be rejected by the officers. There might be additional inquiries of the importer, right? And the value might be decided as per the customs valuation of import of goods rules. As you know, in the customs valuation of import of goods rules, there are rules 3, 4, 5, 6, 7, 8, 9, right? Where you decide the value in a sequential order on a case-to-case basis, right? So what do these rules state? Now, who can apply these rules? The class of goods can be notified under these rules by the CBIC only when somebody applies. And that somebody can be anybody, including the officers of customs. So if they apply to the authorities screening committee on certain goods and class of goods, there will be certain format which will be present online. And if they have reason to believe that the valuation of import of these goods, they are not being done truly and accurately, then they can apply to the screening committee under the CBIC. If the screening committee within 15 to 21 days, if it prima facie finds that yes, the valuation is not truthful or accurate, then it might transfer it to the evaluation committee. The evaluation committee would evaluate the valuation of those goods on various criteria which are mentioned under Rule 8, and thereafter it will go pass it back to the screening committee. If the screening committee finds the evaluations committee's report to be correct, then Rule 11 is the most important rule. it will lay down the procedure in for the valuation of those goods pan India. So in case of, for example, the valuation of computers or laptops are disputed and they are notified by the CBIC under these rules as those class of goods or which are under these rules, then whenever you import the laptops, then certain additional questions could be asked, and if you have to answer them, you have to give certain information, explanations as might be sought, including the value of similar other goods in the market, etc. And accordingly, the import value of your goods would be determined. If you are not able to provide documents instantly, then your goods might be provisionally released with a bond or with a bank guarantee. And in case still your valuation cannot be found out in the as per the rules, then you have to resort to customs valuation of import of goods rules under rule 4 to rule 9. Under rule 4 you have to value it as per identical goods. Under rule 5 you have to value it as per similar goods, deductive value, computed value, residual value, and so on and so forth. Now, one important thing, please note, all the importers should note. One very, very important exception to these rules is that these rules would not be applicable in case you are importing the goods under a mover scheme or under advance authorization scheme or under project imports. Very, very interesting exceptions. So if you are importing these goods for manufacturing, then no problem. The valuation will not be contested. Therefore, friends, what I see from these valuation rules, one good takeaway, while there are many, many things which might create hardships for the industry, one good thing is that in case you are a manufacturer, I would suggest all manufacturers who are importing inputs or capital goods should always go under advance authorization, or at least if you are not exporting, then all manufacturers should go under mover scheme, because these rules also would not be applicable and you can always go for deferred duty payment. So you are under a win-win situation. Friends, our video is there on Tax Guru website, also on YouTube, also in the matter of availment of transitional credit, the GST portal. If you log into your GST portal, you can see in the transitional credit forms that those forms are now active. And in case you have missed out any transitional credit, you can take those transitional credits via this special dispensation as per circular number 180. However, in this transitional credit which you are taking as per this special dispensation as per circular 180, you have to be careful. If your matter is under dispute or under appeals, then you cannot go under this special dispensation from 1st of October 2020. However, if you have missed out any transitional credit, if you want to rectify any transitional credit which you have earlier filed, then you can always go under this new special dispensation as per circular 180. So you go on to your GST portal, find out in the returns part, you go to the transitional credit returns and you need to file these transitional credit forms. Right? One important thing in this special dispensation, well, many of the taxpayers have missed out the transitional credit with respect to unexpired credit in case of services on 1st of July. I will give you an example. Say you have paid the insurance premium on 1st of April 2017 of 1 lakh rupees, 18,000 service tax on that, 15,000 service tax on that. Now, out of those 15,000, only one fourth, that is for 3 months, it is related to the service tax period. And if you are a trader of goods, you are eligible for the transitional credit of the 9 months period from 1st of July 2017 to 31st of March 2018. So if you have missed out these kind of unexpired credit, you can now avail of this special dispensation and take that unexpired transitional credit via this special dispensation on your GST portal. Once you file the statement on the GST portal along with annexure A, then you can go to the department. Within 7 days, you have to file the hard copy, and you have to go with the documents, and your officer will scrutinize your documents and thereafter accept or deny your credit. If he accepts your credit, then it will flow to your ITC ledger. Well, two important decisions by the Bombay High Court in the case of Sodexo India Services Private Limited. Many a times there is a dispute that whether in case of service tax or central excise payment today, whether it can be paid to DR3 or not. Well, various field formations, various commissionerates, they are disputing the payment of service tax of central excise through DRC3 challans under GST. However, as per our understanding, we have made the payment. It has never been disputed. In case it is disputed, the Bombay High Court has directed the CBIC, which will come out with circular in this regard to clarify whether service tax or central excise can be paid through DRC3 under GST or not. Well, very important, and luckily, in case of an advanced ruling, generally you see it is always in the favor of the department. In advanced ruling by the Gujarat Advanced Ruling Authorities in the case of Zydex, Cadila Pharma, now Zydus Life Sciences, it has held that now it is clarified that in case if you are a factory, say you are an employer, you are a factory and you are taking certain sums of money for canteen services, which you are liable, statutorily liable to provide to your employees or workers, then the service of the canteen service itself would not be liable to be a supply, and therefore no question of GST being charged on such services. Many of the taxpayers were charging the GST on these kind of services. They might now stop it, and it is very well clarified by circular 172 in July 22 itself. You can take the benefit of that circular 172. So friends, this is it from our side. These are the very critical developments in the indirect direct taxes regime. We would very quickly, I think we have another 10 minutes to go. We will quickly go on to the questions. Mr. Hitesh says, in this case, if there is a commercial discount, we'll have to keep a record explaining to the department. Well, in which case, Mr. Hitesh, you are not very clear. Okay. What will be the case when an Indian agent of a foreign shipping line raising invoice for foreign Indian agent of a foreign shipping line raising invoice for ocean freight to Indian shippers, customers? Is GST on ocean freight will be applicable in the aforesaid case? Okay, so I think the question is Indian freight and forwarder raising an invoice on a Indian customer, right? I think it would be the GST would be applicable, right, at 5% or 18% in case it is shipped through sea. In case it is shipped through air, at 18% it should be applicable. Mr. Kurana says, if Is the revised rule 37 not unreasonable, because even if small portion of invoice not paid, entire ITC will be disallowed? Yes, Mr. Khurana, I think that yes, it is unreasonable. However, as of now, what it stands, this is the rule, and therefore you have to be very careful. I think the best way to counter this is to take a declaration that your supplier has received the money in full and final settlement. Other, and you can go and take the shelter under the word fails to pay. Otherwise, it could open a real Pandora's box. However, I feel that the CBIC should come out with a clarification circular in this regard. Mr. John says, what will be the impact on import payments if the bill is not paid within 180 days, in which, okay, it is not applicable on import payments on bill of entry. Good question. Mr. Kurana says again, whenever some controversial deduction from invoices are made, the suppliers normally do not agree. In such case, recipient may lose ITC availed by them. Yes. So in case it is a controversial deduction, it is better not to make the payment at all. Okay, Mr. Nigam says difference between GST registration cancelled and suspended. Yeah, GST registration suspended can be revoked. GST registration cancelled can only be appealed against and revoked on the appeal order. What if the invoice dated 31st April 22, I think it should be 30th April 22, appearing in GSTR 2B of April 22 is booked in May 22 and credit availed in 2B of May 22? How to deal with timing differences? Well, there is no problem at all. If you are talking about non mismatching of 2B or excess of credit in 2B, well, that would be taken to be cumulative. Your 2B will be taken to be cumulative as on one day. A 2B of credit of April can always be taken in the 3B of May. Okay, Mr. Saurav Ganguly says, basis on IRN of supplier, e-invoice will not be eligible to avail ITC within due time since it is not appearing in GSTR 2B. Saurav, I think we have answered this because even if the IRN is available in the last GSTR 2B, you can always take it in the next GSTR 3B. Well, I mean, it will not be one, only one period of 2B and 3B matching. It will be cumulative 2B of one period till one period. So, for example, say I will clarify with numericals. Say your 2B of April 22, it is 80 rupees. You take the credit of 70 rupees, right? Your 2B of May 22 is of 90 rupees. You take the credit of that 90 plus you take the credit of unavailed in April 22 of 10 rupees, and you take a credit of 100 rupees in May. The department cannot deny your credit of 10 rupees in May saying it is in excess of 2B. It has to see 2B of May 22 cumulatively with 2B of April and May 22, right? It cannot deny one to one only for one particular period of time. Mr. Swami says, sir, I passed one credit note pertaining to 21 on 30th 9, but IRN acknowledged generated on 14/12 after filing GSTR 1 of September. Can we eligible for availing ITC on the credit note or not? Please provide what is the impact on what that credit note. So you have passed a credit note. So you have reversed the output tax liability in September, and you have disclosed and IRN you have generated in October. So you can show it in the month of November and you can reverse your output tax liability. No problem in that. I think, you have to reverse your output tax liability. You cannot take an input tax credit of a credit note. So freight rate already starts dropping. Okay, so you are confirming that freight rates have already started dropping as per our analysis. Credit note will also populate in September 22 or October 22. Mr. Swami, you have to be a little more clearer. Mr. Shadab says, sir, sea freight tax 5% on which notification? Can you mention the notification number? It's mentioned in my PPT. You can see that. My view is that Mr. Rahul says, my view is that exporter will get the refund, but refund takes time, sometimes more than 60 days. So the working capital will be a great problem. Yes, Mr. Rahul, to that extent, some working capital would be blocked. But as I said, you can negotiate with your shipping line, freight and forwarder to reduce the freight charges. TDS on ocean freight applicable. TDS on ocean freight. Yeah, I think you're talking about income tax TDS here. Well, if yes, yes, it is applicable. In case of export of services, if place of supply is other than territory, then how can ITC be claimed? Suppose both service supplier and recipient of the state same, and in this case ITC will have to be selected. Mr. Redmi, okay, I don't get your name. You are registered as Redmi. There is no problem at all, even if it is an intrastate supply, place of supply is outside India, even then input tax credit of IGST can be claimed. No problem at all. Mr. Hitesh, you are doing a great service in spite of your health issues. Thanks very much, Mr. Hitesh. Hitesh, Mr. Hemant, can credit of KKC, okay, or other cess be claimed under Tran 1? Yeah, very good question, Mr. Hemant. Now, you see, KKC has been disputed in courts. Some courts have held it is eligible, some not eligible. Well, this special dispensation, this Supreme Court ruling in the case of Philco Trade Center Private Limited, it is for not a legal issue. It is that in case of technical glitches or any other issue you have not been able to avail, you can avail the trans credit. But it does not dwell upon whether a tran credit will be eligible other than as per the provisions of the act. So it actually indirectly upholds the other provision of the act. An additional example can be for those invoices which are more than 1 year old, the ITC, the tran credit is blocked. This Supreme Court judgment to that extent does not clarify whether you can take the credit of invoices which are more than 1 year old, right? So to that extent, well, I think picture abhi baki hai. Many other issues are there. You can see in my PPT, I feel this tran credit matter is still not resolved. Kindly share the PPT over email. Yeah, we will share. Mr. Rajesh says a GST taxpayer has imported drilled machinery from its branch in Singapore during pre-GST era. It has returned back the drilling machinery to its branch in 2007. Could it claim the refund of IGST on account of export of goods? Well, if it is a pre-GST era import under GST, you cannot claim the refund of the tax paid earlier in the pre-GST era. Basis, Saurav Ganguly says, basis of IRN of supplier e-invoice, we will not be eligible to avail ITC within the due time since it is not appearing in 2B. Okay. So in case your your IRN has been generated after the time barring period, uh, well, if your IRN is generated after the time barring period, if you go strictly as per Rule 48, then your ITC is not eligible. However, in our opinion, the matter may be contested because it is a substantive claim and IRN, even though it is delayed generated, it is generated, and still your tax invoice remains the invoice which is generated by the taxpayer supplier and not the e-invoice. Therefore, I think ITC should be eligible in this case. It can be contested on this basis. Okay, can we take input tax credit on canteen services provided in factory where it is mandatory? Well, you see, in my view, yes, it can be taken, but it can be contested by the department under 17.5. Excavator used in query, is ITC allowed? Of course, yes, ITC is allowed. Mr. Vinay Goel says, very, very useful webinar. Well done, Vivekji. Thanks, Mr. Goel. Okay, furniture purchased for lodge, is ITC allowed? Of course, if it is a movable furniture, ITC is allowed. What if tax invoice not proper? Can ITC be denied? Yes, under Rule 36, sub Rule 2, ITC can be denied in case all applicable details as per Rule 46 are not there on your supplier's tax invoice. Share PPT if possible. Yes, PPT will be shared. Mr. Janil Shah says whether NBFC can take ITC on insurance premiums paid to insurance company for loan sanction. Yes, but 50% reversal has to be made. Yeah, you are correct. Mr. Sunil Giri says, I reversed the ITC within 179 days, then shall I be liable for interest? No. Mr. Pramod says there is timeline for taking ITC base bill of entry. No. Okay, canteen deduction decision is applicable to all. Yeah, it is not applicable to all, but because it is an advanced ruling. However, this circular 172 is applicable to all, and that it is clearly clarified. Mr. Swagat says whether interest is to be paid on ITC reversal up to availment date, utilization date. ITC reversal up to availment or utilization. Well, I think it should not. It is post this 180 days where interest is applicable, not before 180 days. Mr. Srikanth, if e-invoice IRN wrongly cancelled but vendor but ITC appearing in our 2B, is any dispute to claim? Yes, there is a there may be a dispute by the department, but it can be contested as we have discussed earlier. Okay. If any other territory is selected, then GSTR 2B it comes under not available. Okay. Okay. So if it is coming under GSTR 2B, this ocean freight matter, if it is coming under not eligible, then well, that needs to be checked. But there is no way where the ITC can be denied. That much, I can tell you. If the department denies it, I'm sure it has to be contested. It is a rightful claim. Due to a technical glitch, it cannot be denied. A supplier in Delhi supplies goods to Kerala recipient as X. Okay, there are many, many, many queries. A supplier in Delhi supplies goods to Kerala recipient X go down. Actually, the recipient received the goods at the premises of the supplier, but the goods not reach the recipient premises in the month of the invoice as it is in transit. The seller has no liability to ensure good received, the goods reach the premises in the following. Can the recipient, since the no, the recipient can claim the credit only in the month in which he has received the goods in Kerala, even if the risk and reward has transferred in Delhi, right? Okay, or As suggested for 1 and 2 bills in case of freight forward, the tax rate of other charges takes the color of tax rate of freight considering, okay, considering it as a composite supply. Mr. Shah, in my view, it cannot be considered as a composite supply in this case. Also, place of supply is different. So how can you consider it as a composite supply? I think it cannot be considered as a composite supply. In my view, it cannot be considered as a mixed supply also, right? Mr. Advani says is the export of machinery to its branch in Singapore a zero rated supply? Okay, if it is a branch, it is an export of machinery. So in case of goods, an export is an export. Just once it moves outside India, it is an export. So yes, export, it is a zero rated supply. If the payment, okay, last question we will take. If payment has to be made within 180 days, then why department allows extra 7 months time after financial year to claim GST credit? Well, this is a statement. I think we have to ask the CBIC. Okay, so friends, thank you very much for joining, and we will keep on holding these kind of GST and indirect tax, customs, DGFT related seminars. The PPT will be shared with the participants by Tax Guru. Thank you, all the participants, for joining. And thank you, heartiest thanks to Tax Guru for holding this webinar. Thank you very much. See you soon.
Thank you, Vivek sir, for this wonderful deliberation. Thank you all the participants for attending the webinar. We conduct such webinar every month, and we hope we will get you in the upcoming webinar as well. We will shortly share PPT and video link to all the participants. Thank you.